Oil prices actually sliding this morning after President Trump made some comments about leaving Iran in a couple of weeks. You can see WTI this morning off by about 2.6%. It's below $100 at $98.75. Brent is also down, trading at about $101.50 a barrel. Joining us right now is Daan Struyven. He is Goldman Sachs co-head of Global Commodities Research. And Daan, walk me through how you start trying to figure out what's happening with oil prices, what's happening beyond this. How do you interpret what the president's had to say? Explain.
Yeah, so I think in the short term, oil prices are really in a tug of war between, on the one hand, the passage of time leading to large supply losses and upward pressure on prices, on the one hand, and on the other hand, comments from policymakers potentially reducing the probability perceived by markets that this will be a very lengthy disruption. And the decline in prices we have seen over the last 12 hours are in the second category, where I think a lot of investors have downgraded their probability of a very sustained supply disruption. And so some of the risk premium comes off.
What happens if the United States pulls out, exits the Iran war, and the Strait of Hormuz is still closed, potentially, or hasn't been settled, hasn't been resolved? What happens to oil prices?
Yeah, so I think an exit by the U.S. would definitely increase the probability of a normalization of flows to the Strait, but that would also depend on the behavior of Iran, the behavior of shippers, potentially the behavior of Israel. For now, flows to the Strait remain very low. You're down roughly 19 million barrels per day relative to normal levels, but we have seen a big pickup in redirection via pipeline flows.
You mean going across and getting out through the Red Sea, or are there other aspects on this?
Exactly, the East-West pipeline that brings the barrels to the Red Sea.
I guess I wonder, the president's point is that the rest of the world needs this oil more than we do. The United States is relatively independent when it comes. It's able to produce its own oil.
Yep.
Is this a problem that really hits Asia and Europe? Or are there, what happens to the global oil market if we leave and the Strait is not opened?
Yep.
And does it affect us? Obviously, it would affect them more, but how do you kind of play this out?
Yeah, so in the short term, the risk of hitting critically low inventory levels is clearly larger for regions that are big importers from the Middle East, especially Asia. Over time, because the oil market is a relatively global market, because oil is relatively fungible over time, the upside price pressure that really started, for instance, in the Middle East, you saw Dubai and Oman prices being very high. Over time, these very strong incentives, for instance, for U.S. Energy producers or exporters to bring those American barrels to the rest of the world, suggest that over time, those prices should converge.
So the oil market today is trading with a premium that tells you what? That you think that this conflict will be over in 2 to 3 weeks? That you think things go back to normal? What is this telling you? And I guess we should look at some forward contracts, too. We're looking at the May contract for WTI.
Yeah, so the oil futures curve is pretty close to our own forecasts, with, for instance, Brent in the fourth quarter averaging $80 TI in the mid-70s. That forecast is generated using our pricing framework and the assumption that flows to the Strait start to normalize gradually from mid-April onwards. So I do think that the market seems to be pricing a scenario that's pretty close to that.
So we would say that basically reflects what President Trump is saying right now, that a few more weeks and then that's it.
Yes, that said, we do think that the risk to that timeline are skewed towards delays, and the risk to our forecasts are skewed towards higher prices. This is just a very large supply shock, and so even under a small probability of lengthier disruptions, it should have a big impact on your average price.
Okay, so you don't anticipate prices coming back to below $60 where we were pre any of this?
That's right. Our base case for oil prices in the fourth quarter is about $20 higher than before the war because of a large hit to commercial oil inventories. Mm-hmm. Restocking by strategic petroleum reserves.
Right, a while.
And we also think that oil prices should incorporate a security premium to encourage supply diversification.
Okay. All of this, we've watched energy stocks do very well. They've been the leaders over the last month. It's the only sector that hasn't been in negative territory. You would anticipate, I know you don't cover stocks as much, but is that kind of telling you the same thing, that maybe their estimates for what's happening kind of follow your estimates for oil prices too?
Yeah, so the view from Goldman research is that in the long term, Brent should sort of average around $75. And I think the rally in some of the equity stocks, which are more priced off prices a couple of years from now rather than the spot price,
right,
is broadly consistent with the market taking on board that more constructive view on oil prices down the road.
Okay. That's a nice way of saying higher prices, more constructive, right?